the terms matter when you're picking your mortgage. Like, for example, a lender might come to you with a rate that's point 0.1 better than you're getting from us. And it has a bona fide sales clause attached to it. It has only provincial movement attached to it. So if you, for instance, get that dream job out west, there's some lenders that'll allow you to port your Ontario mortgage to out west. But if it's one of these lenders, like a lot of credit unions, for example, if they don't have an established presence out there, you can't port. You now have to pay the penalty to break that mortgage. And that penalty is going to be either the interest rate differential or 3 months interest. So you're going to have a pretty hefty penalty on it.
Yeah, so that leads us into our third point, penalty, and that can be quite literally thousands and thousands of dollars to break your mortgage if you have to break it. Now, we're kind of in a funny time because, well, there's two different types of penalties. There's a 3 months interest penalty and there's an IRD penalty. And that all has to do with when you break your mortgage, you're paying that penalty 9 times out of 10. And if you are in a variable rate, it's always 3 months interest. If you're in a fixed rate, it's either 3 months interest or the IRD, which is interest rate differential. We're not going to go into all the details on how it's calculated because we will probably bore the heck out of you. But just know that IRD is usually going to be higher than the 3 months interest. But we're in a funny time right now where it's actually not. And the 3 months interest penalty is actually the greater penalty than the IRD. That's just because of where rates are at now versus your rate that you currently have now is likely lower. So the 3 months interest is actually higher. But to give you an example, if you're breaking a fixed rate and you're in normal times where rates aren't volatile like this and you have that IRD penalty, you could be looking at anywhere between 3 to 5% of the mortgage amount in terms of how much you have to pay for your penalty. So you can just do the math on there with your current mortgage now, and it's quite a bit of a penalty that you have to pay. So that just reinstalls the fact that having those porting features are very, very crucial.
For sure. And especially now where, so the IRD penalty usually kicks in when you're in a declining rate environment, which for anyone who's taken fixed products over the last year, the next couple of years, we're probably going to be
Yeah.
back in that position. So when you're looking at, okay, well, maybe I can get a lower rate today, you want to compare what is the payment of that over the whole term, and then what does it look like to port? Because it might actually make sense to port a mortgage that's a higher rate versus paying a penalty when it comes down to the overall cost of it. And that's what we look at. A lot of places, like if you go on like rate hub dot whatever, and it's just going to compare monthly payment. That's the only thing they factor in. We compare what's going to save you the most amount of money over the whole term of your mortgage and your lifetime as a borrower. And that is a way better option. Like if I save you $50 a month today, but it costs you $12,000 2 years from now, what have I done for you? Nothing.
Yeah, exactly. And you can kind of think of that $50 in that example as kind of like an insurance for you in the future. And I find it is a hard decision for people because everyone lives in the now. And even if you don't plan on breaking your mortgage in the future, shit happens. And you would be amazed how many people break their mortgage before their 5-year term is up. So I would much rather pay that insurance. I'm calling it insurance, the $50 extra a month in that example, than going with something that's lower and not having that feature, or going with a fixed rate, a long-term fixed rate, knowing that fixed rates are probably coming down in the next year or two. So that's a great point.